Hello and welcome. My name is Jason Martin at AllGen Financial Advisors. And with all the news recently around the Iran conflict and what's going on in the Middle East, the news can be unsettling. So I wanted to take a few minutes and just walk through what's going on exactly and how is it affecting the markets. And most importantly, how is it affecting your portfolio, along with kind of historically, what have these type of geopolitical events done to the markets? And just so you can be better prepared, sleep a little bit better at night, and know that what we're doing behind the scenes to protect your account and potentially even grow it further. So let's jump in. Most of the Iran conflict, in terms of how it's causing issues in the market, is all kind of around this one little piece of land right here. Actually, the Strait of Hormuz, if I pronounce that correctly. It's about a 20 to 30 mile wide strip of water that a lot of these oil producing nations, like Saudi Arabia, Kuwait, Iraq, Iran, even, when they export oil, they have to go through that strait. And so, since the U.S. and Israel have launched the attack on Iran, that Iran has threatened to and has effectively, at the moment, shut down this strait to basically restrict any boats from going out of that. Now, why that's important is because about 20% of the world's oil and natural gas are come from that area. And so, one thing that is important now, let me make my a little smaller here and move it over so you guys can see. But 70% of the oil that's coming out, especially from this area right here, is going to Asian countries. So mainly China, India, Japan, and South Korea. And so it's going to affect those areas a little bit more than it would affect the U.S. and oil prices in the U.S. But the important part to understand here is what that does to global markets. And if oil prices go higher, natural gas prices go higher, and it stays like that for an extended period of time, that could cause consumer prices to go up from the cost of transportation and everything that goes into getting a product to your door. So another thing to keep in mind too is that OPEC plus nations have already said that they're going to increase supply to be able to protect for increased prices from the lack of the exporting oil and natural gas from this area. So that's really what's causing some nervousness in the market and what's affecting the economy the most. Now, as we kind of look through exactly how it's affecting markets, you can see oil has jumped. And so right now, oil is up about 8% and initially jumped over the last couple of days. And this morning, it got up to $75 a barrel. This is as of the close of day, March 3rd right now. But it did finish the day around 71. So that's up about 10% from where it closed before the conflict started. So that's something we will certainly be monitoring. Our portfolio does have a small portion of oil stocks in it, and that has definitely helped those stocks. But the other portion too is in a scenario like this, and when there's a geopolitical event, there's usually a flight to safety. And one of the asset classes that tends to be considered a safe haven asset class is the U.S. dollar. And so, as you can see here, the conflict happened, or this was the close of last Friday, and then you can see over the last couple of days, the dollar has gone up, and in fact, it's gotten pretty close to an 11-month high. Not quite broken out from that yet, but it has gone up quite a bit, which is quite interesting because if you look here, about a month ago, everyone was very concerned that the dollar was crashing. How quickly that narrative has changed. But there is constant consequences of the U.S. dollar going up, and that can bring down non-dollar denominated assets and even hard assets. So you can see this is a chart. It's the Vanguard FTSE All World Index. I'm using this just as an index for international stocks. And as you can see here, International stocks are down about 5% over the last couple of days. Now, that's actually been an area that has been significantly outperforming over US stocks over the last about year and a half. And so while our portfolio is slightly overweight international stocks, just slightly above neutral, this is actually looking potentially like a setup that we may want to take advantage of. Is if we can get international stocks a little bit cheaper and then this conflict subsides, maybe a good opportunity to add to that position in our client portfolios. But just to kind of give some other reference points of other asset classes, US stocks are actually holding up pretty well, only down 1%, and US bonds are only down about 1%. Another consequence of the dollar going up so strong is it has caused gold to go down a bit. So gold's down 3% right now. All right, so as we continue on here, I provided this slide, even though it's a very busy one, just to kind of show you all the different wars over the last 100 years. And I point this out just to say that the world, unfortunately, has constant conflicts. And the market over time has continued to be resilient and continue to go up over time, even though despite even though we've had all these different wars over time. Now, what does that mean for markets? So if we look at this chart and look at the different geopolitical events going back to 1941, you can kind of see, what was the kind of initial reaction? What was the largest drawdown? You can see the Pearl Harbor attack. This is the Pearl Harbor attack. It was down 20% during its largest drawdown. Iraq's invasion of Kuwait. The North Korea invade South Korea. As you can see, these are the largest drawdowns of any of those events. Now, I find this interesting. Here's the number of days it took to recover from that drawdown of these geopolitical events. You can see this one was 2 weeks. This one was a month. The invasion of Kuwait was 108, about a half a year. And there's a couple of them that didn't even dip. The Israel-Hamas war and Russia invading Ukraine, the market didn't even dip. And then obviously the Pearl Harbor attack, that was the biggest one of them all. Now, by showing this, I'm not saying that it's not our base case that the U.S. enters a long extractive war. I think the base case there is maybe a few weeks. I know the Trump administration has been talking about potentially 4 weeks, but we don't believe this is going to be a long, extended event. Now, another interesting thing to point out here is that look at the returns 1 year after the event date. You see 34%. There was 2 negative time periods. This one right here, Russia invading Ukraine, which really didn't have much to do with Russia invading Ukraine. As you can see, that was 2022 when that was a big inflation year in the U.S. And then this is the U.S. terrorist attacks of September 11th, and that was really in the middle of a tech bubble kind of crashing, if you will. And so, even though those are the only 2 of the 8 big geopolitical events here that were down, those 2 events weren't really because of that geopolitical shock. But look at the numbers as a whole. The majority of them had really good returns at 1 year later. In fact, better than average market returns. So something to keep in mind, a lot of times these geopolitical events, even though they're a little bit scary and can cause a lot of heightened news coverage and fear, they a lot of times are actually decent opportunities to invest. So here's the returns of different war times. So here's the average return since 1926. It's an average return of 10%. You can see during World War II, the market averaged 20%. The Korean War, 15%. Vietnam, 6.5%. The Gulf War, 10.1%. And the Iraq War, 6.8%. So you can see that war times don't really negatively affect the market per se. In fact, in some wars, it's caused, and these are large wars. The Korean War, the World War II was a very large war, and that caused markets to really go up. Now, things happen during wars, and that manufacturing increases a lot, and governments tend to stimulate during that time, which can be good for the economy. It could have negative ramifications of potentially more inflation, but it typically has not been necessarily a bad thing for the stock market after that initial volatility. And then you can see here's the average S&P 500 returns after geopolitical events since 1980. Every single time frame here, one month, 3 months, 6 months, this is 1 year, has been a positive return. So again, just furthering the point that geopolitical events don't always cause downward markets and cause a market to go into a bear market. They do initially cause some volatility, but on average, markets are positive after these types of events. So all that, just to sum it all up, history favors patience. So the median drawdown of geopolitical shocks was about 7%. With markets positive 1 year later, 8 out of 10 of the major conflicts. So it's super important to keep the long-term view in mind and avoid panic selling. I know the news can be scary. Our thoughts and minds sometimes can have this fight or flight mentality. And I would just say usually the biggest mistakes an investor can make is to sell when things are scary. Those are usually better times to buy than they are to sell. Just so you know how we are positioned, that is, our philosophy is to manage risk really well and avoid large drops. So we do have multiple assets in your portfolio that are non-correlated, that don't all go up and down together. And we focus right now, our focus is on higher quality bonds. We do have gold in the portfolio. And then we do adapt our allocation based off of where we see the market going. And obviously we don't know the future, but we use a lot of indicators to kind of gauge what's the highest probability of multiple scenarios playing out. And we try to position our clients' assets in either what's doing what we think is going to do the best when times are good, or what we think is going to hold up the best when times are bad. And just want you guys to know, we are actually searching for opportunities. These types of events usually cause opportunities to pop up to be able to buy into certain areas that have dipped and are giving you an opportunity to maybe get in lower than what you could have gotten into that particular asset class if the market would have just kind of been steadily moving up. And right now with international stocks down, and the fact that that's been an outperforming sector and the valuations are a little bit better than in the US, that's an opportunity for us to potentially be able to get into some of those markets. We're looking at that right now as an opportunity, and we'll see if we get a chance to pull the trigger if everything lines up. But I just want you guys to know we are actively monitoring the situation, and we are positioning your portfolio to protect and to manage it really well. And just want you to know that we're on top of it. And if you have any questions whatsoever, feel free to reach out to your advisor, and we'll be happy to answer any questions you have. All right, hope this helps. Take care. Bye now.